Hello, everybody. Welcome to today's session about exit strategies for angel investors and also founders. We have Cosmin Ochișor today with us. He's a GP, a general partner at Gapminder, one of the first Romanian VCs, a VC that is now preparing its second fund of around 80 million euros. Cosmin has been with Gapminder for more than 5 years and previously worked at Hubraum, the venture division of Deutsche Telekom, for around 5 years. So lots and lots of experience in this venture capital world. One important mention before we start this session, Cosmin is also one of the speakers at Invest in Moonicorns, the first angel investment event that we're organizing in Romania. The agenda of the event will cover all the phases of doing angel investing, sourcing, picking, and winning. We'll have almost 30 speakers on stage that will share their experience about success, about angel investing, about how they are doing each of these activities. And we'll also have some cultural happening in the second day, because Timișoara, the event is happening in Timișoara, and Timișoara is the European capital of culture this year. We'll visit the Brâncuși Expo, a very special expo that it's super new for Romania. Hasn't been done for 60 years, something like this. And we'll also visit the city center of Timișoara, the Cetate, the old city, and find out more about this beautiful city I live in. So if you're interested in angel investing and you want to join us, please visit the website moonicorns.com. You'll have it on the screen soon. Cosmin, thanks a lot for accepting our invitation. Welcome.
Thank you for inviting me.
Yeah, I'm looking forward.
I hope it will be useful.
I'm sure it will. It will be super useful. As I said, you have an extensive experience in venture capital. I'm super curious. Why are you in this field? Why have you chose this industry?
To be honest with you, it's kind of not very evident, and it's kind of difficult to really have a think about a career path. Honestly, I had the opportunity to have different contacts in this world, in the world of startups, actually. And from the moment I got, let's say, understood what it's happening actually in this innovation field, I would say I wanted to stay into the innovation field. So basically the first step which I did was inside the Deutsche Telekom. So I worked like 10 years for them in 3 different countries. And I had the opportunity to join this project, which was actually an accelerator addressing Central Eastern Europe. So I would say that I made my hand there, like working with startups and also learning the basics of investments and so on. But all in all, I would say the main reason it is actually the people which you find in this field. I mean, I'll be honest. So you are surrounded actually by probably the highest quality people. I mean, it's all the time like very smart people, very ethical and so on. It's really rewarding to work in this environment. So I really like it. Also, I'm a kind of a bit of a geek. So I all the time like all the new technology, all the new gadgets and everything. So it kind of came to me like a glove, you know. So and I had the chance to step in, and then the second step was like moving from the corporate world, the let's say private venture capital, let's say, or I would say like pure blood venture capital, because corporate venture capital is slightly different, but investments are done the same, but it's different also in terms of exits and everything. And yeah, so people, honestly.
People,
Yes.
And innovation, basically, right? It's
yeah.
Nice ideas every day. People
Exactly.
Changing the world.
Yeah,
super cool. Did you also do angel investments, or you jumped directly into the VC world?
Before, not really. I mean, as I said, I'm coming with a corporate background, and now I'm acting in the venture fund. Well, even if I want to do it, it's kind of a conflict of interest. So if I invest in a company, then it's kind of difficult to say that it's a good company and the fund should invest in the company. So not really. I mean, I invested rather in a couple of things. I invested in a couple of Web3 projects, like a personal hobby, I would say, because we don't do Web3. So I did a couple of them, not many, but I did a couple of them. So yeah.
Okay. Yeah, this will be one of the things, coming back to the event we're organizing. This will be one of the cool things. We're going to have a panel comparing basically the asset classes. We'll have someone from real estate, someone from the stock market, someone from crypto joining this venture world, and discussing about these different asset classes. Yeah.
Honestly, I put a little bit of money there because I wanted to understand. I mean, because on the normal, let's say, in my normal business, we don't do these things. I mean, even before, and I just simply wanted to understand and what's the best school of doing it, if not like doing it with your own money, and to see what's going on there. So.
Yeah, absolutely. Yeah. And it's a fascinating world there.
Yes, absolutely.
Looking at your activity basically in Gapminder's first fund now, because you're preparing the second one.
Yes.
You were involved. I think you managed basically the Freezebo investment, Smart Dreamers investments, Solidify, DeepStash, Machinations, Planable, and so on. So you were super involved in making the investment decision for many of the fund's investments. I'm curious, what were you looking for? What were the criteria you used to make the investment decisions?
Yeah, so okay, the decision was not mine. So there is an investment committee. I mean, I'm part of the investment committee, but also the other partners on the investment committee. I was, let's say, maybe the internal champion, so the guy which brought the deal and actually supported and in the front of the investment committee and basically working after that with the company. Yeah, I would say it's quite diverse. I mean, the list of companies which you mentioned, it differs. I mean, it's not all the time the same. But I would say, again, I'll start with the first point which I mentioned into this discussion. I would say at least in half of these cases, the main reason was the entrepreneur, to be honest with you, because some of them are not necessarily, look, for example, DeepStash, it's a consumer company. So we don't do consumer, but we did it because actually of the entrepreneurs there. We just trust them. And sometimes even if you don't understand the field, you just trust the people there. But that's unusual, I would say. So no, this is just one exception. But first of all, it was about the people. I mean, if you feel inspired by the people and you think that these guys are really able to do it, that's let's say the main criteria. And then you start thinking, I don't know, about the product which they want to build, the market which they are addressing, and then so on. I mean, I wouldn't say that it's not important and only the people matters, but also the project itself. At the beginning, I mean, depends also of the stage of the company, because if I compare, for example, Solidify with Freezebo or even Smart Dreamers, is quite different. I mean, Freezebo was a kind of mature business. I mean, it was they have already processes in place. They have customer. I mean, they are just trying to grow and to conquer, actually to go abroad. Yeah, to go abroad and also to sell their services also outside Romania. With Solidify, it was very, very different. So it was like basically there were like 5 guys in an apartment trying to build
super early.
Super early, no revenue. And trying to build something really crazy. I mean, if you say back then, they say, look, I want to create profiles of all small and medium enterprises in the world. And now they have like 80 million profiles in their database, selling to very, very big customers, mainly in North America and so on. And the team was very young. But it inspired me at least. I mean, okay, these guys is really smart. They are really motivated. They may do it, but it's all the time. I mean, a a bit of a bet, but also I guess the audience understand that very well, because
this is why it's called venture.
Yeah, that's why it's called venture. Yeah, but usually, I mean, the angel investors, they enter even before us. So
yeah, exactly. But nowadays it's a bit of a mix. It used to be like this. Angels were super early, and then the VC came. But now I see more and more VCs that are investing super early, even in pre-seed stage, idea phase, and so on. So
yeah, it's working. I mean, usually on the more mature ecosystems, especially Western Europe and North America, you have the accelerators, which are the first investors, and actually the demo day. It's about raising the first money from outside the, I'd say, friends, fools, and family, and then you have, it's a mix there of early stage funds with angel investors and so on. Yeah, it's true. I mean, also we did a lot of deals together with angels. So yeah, it's not necessarily a rule anymore.
Yeah, with Grochan also we have some common investments.
Yeah, we had some deals together.
Coming to moving slowly towards this, the core subject of this discussion, exit strategy, basically. I'm curious, when you invest in a startup as a fund, how early do you start thinking about the exit? Are you thinking of this pre-investment? Do you already start building or I don't know, contouring a strategy? Are you doing it when you make the investment decision, or afterwards in the DD? I don't know, in post-investment. When do you start thinking of this exit?
From the first moment, to be honest. I mean, it's one of the key things. So as a fund, we do things, I mean, a little bit more, let's say, formally. So we document each and every deal, and I mean, together with the due diligence documents and so on. So we also have some internal documentation, I mean, motivating why we are investing into the company. And the one chapter there, it's actually potential exits. Of course, at the beginning, I mean, it's very difficult to know, I mean, what will happen in 5 years, 7 years from the moment of the investment. But it's very good as an exercise, because first of all, we are thinking about how big the company can be. This is the first thing. I mean, before thinking to the buyers, you think how big it can be. Here there are things not necessarily related only to the market. Of course, the market is one thing, because you look, okay, they're active in that market segment and the market is growing. I don't know, maybe it is like a double-digit growth year over year. Then you also look to the team. I mean, do you see this guy, I mean, this entrepreneur able to, I don't know, to manage a company of 200 people or something like this? Because, well, let's say, how this company will look like being I don't know, a business of 100 million a year. I know it's just a story, but it's a very good exercise, to be honest with you. And we do this at the beginning. So to understand a little bit how the market looks like, I mean, if it's consolidated, or if there are like any sort of M&A activities there, and if there are like previous M&A activity in that market segment, what are the multipliers of the deals, because you can find out this sort of information. Then after investing, honestly, we don't do it proactively in the first phase. I mean, we just try to help the company to grow and to raise more money from other investors beside us. Usually, I mean, what we have in mind, it is like the average, the holding period for a fund, it's like around 6 years. Okay, it can be in some cases 3 years, in some cases it can be 8 years. Why not? But I would say in average, and this is what we are aiming for. So maybe after 3-4 years with the company, we start thinking about it. But this is you need to understand. I mean, the company grew. Usually they have more investors inside. It's more like a collective decisions. And there is also one very important thing: you cannot sell the company without the entrepreneur. So the entrepreneur needs to
be on board.
Yes, absolutely. But usually it's coming. Usually when you do subsequent rounds, when you do investment rounds, for example, in fundraising, sometimes you can also get like offers from private equity funds, which usually are buying the companies. They get control, or the word spreads into the market and you can get acquisition offers and so on. But of course, in the company, I would say it's like post Series B and something like that. Yeah. So we do this exercise at the beginning, but more to assess the potential. It's the
so basically there are 2 phases.
Yes.
At the beginning, you assess the potential. You try to understand how big the company can become.
Yes.
Can get. Is the market big enough to support a large size? And are the entrepreneurs capable to manage the scaling process, basically hiring people, then managing big teams and so on. And after you make the investment decision, after you invest, you look for another funds, another VCs to help the company raise more money to get there. And how involved are you in finding, the end buyer, basically? As a fund, I can assume you aim to stay in the company until it is bought by a PE or, I don't know, a strategic buyer, or maybe it does an IPO, right?
Yeah, eventually. We are trying to stay with the company as long as possible. We are more involved in fundraising. I mean, this is, let's say, our bread and butter. So because we have quite an extensive network of people in this field, I mean, usually bigger funds than us from other countries and so on. Usually the offers, I mean, we do also the let's say the M&A process. We do it proactively sometimes, but not most of the times, because again, I mean, the offers sometimes they are just coming. I mean, the most important thing it is to have a very good company, to be a successful company. If the company is successful and it's growing healthy, people will find out about them. They'll get contacted. But also we do some. I mean. Now, because we are in year 6 with the first fund, we started already to think about some of the companies. I wouldn't say that the companies, especially the first companies in which we invested, we started to think about and how the process looks like. So first of all, we just do market mapping to understand, I mean, really in detail how their market look like. I mean, their market segments, who are the main players, because usually you are aiming for a strategic buyer. You have different kind of buyers. You can have an acqui-hire, you can have an asset sale, but these both are not good exits, I would say, because they have like a lower value. You can go in each of them if you want. What you are looking for, it is a strategic buyer. I mean, because if it's strategic for them, it can be either they want a specific geography in which they are not present, either they want some of the customers, either they see a potential to some potential synergies, for example, that they can upsell your product to their customer base and so on. And usually they pay premium for that because it can help their business. And we are doing that. We are trying to identify. Sometimes the best companies to acquire a company are, I wouldn't say competitors. We can say even competitors, slightly larger, but not necessarily aiming for the, let's say, the Microsoft of the world or the Oracle of the world, because these are so big companies and they have different reasons to acquire somebody. I mean, the business should be way bigger. But sometimes a competitor means usually they are backed by big money, so big funds, and usually they are raising money exactly to do that. So in private equity, it's known like this buy and build. So when you see that some players in the specific market segment are raising like big money, sometimes the money are for acquisition as well. So for their,
Okay, super cool. So recapping, before the investment, you try to understand how big the company would be, how big is the market, are the founders able to scale this company to a super large scale to have a good exit. After the investment, you focus on growing the company. So not on exit, but on growing the company, supporting them in future rounds. So they have the means, they have the money to scale fast. And when you get into I don't know, 5th, 6th year of investment, you start doing this market mapping where you're trying to identify potential buyers for the company. Excellent. Super organized work in a VC. Should a business angel do it differently? Do it the same or do it differently? What do you think?
I think they should do it slightly different. I mean, okay, yeah, do you have like a couple of options? Of course, you can stay with the company and just, I don't know, follow, let's say, an early stage investments and do what they do. But I think the best option for an angel to exit a company, I mean, first of all, they shouldn't necessarily focus. Very, very rarely the angel investors, they stay with the company till, let's say, they get acquired, because they have other opportunities beside the fund. You know, you can do like secondary transactions, and usually these come, let's say, after another 1 or 2 rounds. You can sell maybe not all, maybe part of your money. You just minimize the risk. For example, you recuperate your money and you keep a little bit, which is like pure profit, but you don't lose money. I think the secondary transactions are the best for angel investors for a couple of reasons. I mean, there are many reasons. Of course, when you think to multiples, of course, you are losing some opportunities. If the company will become the next UiPath, well, yes, you lose some opportunities there. But it's not necessary. I mean, like this. What are the advantages with the secondary transactions? So first of all, you can do it because usually in an investment round, the company gives away like, let's say, 20 to 30% equity. Sometimes it's a matter to a secondary transaction. It's a matter to negotiate the valuation, because usually when you sell in a secondary, you sell with a discount. It's all the time with a discount. It's not. It won't be the value of the round. That's impossible. But usually, as an angel investor, you own like a single digit. I mean, you own like, I don't know, 1%, 3%, maybe 5%, if you are lucky. And usually, that kind of equity, it can be absorbed pretty easily in a round. I mean, the scope of the investment round, of course, it is to put money in the company. But if you have like sometimes the funds, they like that. I mean, they can buy a little bit more equity at a better price than the round. I think it's a win-win situation for everybody, this part. Then there is another thing. I mean, sorry, go ahead.
I'm sorry. I was going to add that also the founders, they don't dilute so much if the early angels are selling.
I think this is independent of the founders, because if there are if there is too much dilution, usually they can get a kickback from the employee stock option. Sometimes also this happens. So you have other mechanisms to solve this. Another reason is the following. Let's imagine that we have a very successful company and they started to get money from, let's say, UK-based funds or US-based funds. This is the moment when actually the company, they will move outside of the country. So they will be a Delaware company or something like that. And then the complexity kicks in. I mean, you suddenly, compared to a simple SRLA, you will have like different classes of shares, maybe 3, 4, 5, 6 classes of shares. And usually the first investors, they will get simply common shares, which are not different than the shares owned by the founders or by the employees. And this brings some risk. So first of all, you have almost nothing to say because you are too small in the company. Second, you have each and every institutional investor, usually they have liquidation preference. So, you know, the principle is last in, first out, something like that. So, you know, sell the company, the last investors, they will get their money first, and then, you know, it's cascading. So there is a risk, even if the company will be sold in a profit, that you don't make actually so much money. If I would do like angel investors, I would aim for getting for secondaries. I mean,
How soon? How soon? You invest in pre-seed, seed usually. How soon would you exit?
It depends when you have the opportunity. I mean, you can have the opportunity even at Series A. If it's a big round, you can do it. I mean, if we are talking about, let's say, 10 million round, it is possible to sell. Yeah, and at the end of the day, I think like aiming for, investing in startups, it's no different than any other investments, type of investments. You need to have your own goal. For example, I don't know, say, look, if I'm making 2 times or 3 times the money, that should be good enough. Usually you get, as an angel investor, very good valuations. So if you do that, of course you lose on other companies, but everybody should make their own math. And if the goal is reached, I mean, at the end of the day, cash is the king. So
yeah, absolutely. This is the discussion that I sometimes have, but not too often, with angels in regards with what's the core KPI we're looking at when we aim for financial return of this investment. Because as an angel, you also have this emotion. You invest with your heart always. You have a deeper motivation than the financial part. But when looking at the financial part, you either look for a multiple, and this is usually what I see. But multiple does not have a time function, right? If you
time is also important.
It's super important, right? Because you can have a 10 times multiple in 9 years or a 3 times multiple in 3 years, right? And yeah, as you said, you can exit early and have a lower multiple exit, but then you have the cash to reinvest and generate another multiples on the same cash.
Yeah. So I think the secondaries are the best option. I mean, even for funds, I don't know. With the funds, you also, as a fund, you can exit, I don't know, in a Series D or whatever. When you get like, if it's really, really a big company and so on. But usually you own more equity. It's very hard to, to be exited via this route. It's very difficult because of the amount of equity which you own. As an angel, you can do it. I mean, everybody will be happy about it.
Clear. I'm curious, after investing as a fund, so with the fund hat, not the angel hat, are there things you can do to maximize the exit chances or the exit value besides supporting the company growth?
I don't know, if it's a good company, you will have a good value for the company. Well, you can, timing, it might be a factor here. Nowadays, I would say that 2022, 2023, it's not the best time to exit. We should wait till, let's say, the interest rates they go back down, and then you'll have more money into the market and better chances.
Yeah.
Just to give an example, but honestly, I mean, having a good business, a solid business, you can all the time raise money. You can all the time find a good investor and so on. But the only thing which you can do is timing, or also maybe to think in advance to say, okay, it will be difficult for the company to raise money in a year from now. Let's not wait till they are running out of cash. Maybe let's think about having some signals from the market with 1.5 years before they run out of money, for example. This is maybe a healthy thinking to detonate a bit the market.
Yeah. So basically, if a fund after investment focuses on helping the company more than thinking of exit, probably this is the same advice for a business angel, right? Because anyhow, as a business angel, you don't have the steer power. You cannot steer the business so much. So what you can do is really put up your expertise, your connections, your network to support the founders and maximize the chances of the company to grow, basically, and not influence directly the exit, right?
Absolutely. I mean, that's why. But it's kind of complementary. I mean, from my perspective, angels and funds, they do different things in a company. I think we are way better to help the company on the finance level, not necessarily like doing financial services for them, because we don't do that, but for helping them thinking the right way, this thing, and also helping them to raise money, because it's more easy as a fund to have direct contacts to other funds, for example. But on the other hand, I mean, what an angel investor can bring on the table, it's exactly the expertise, the management expertise. Because you guys, I mean, usually most angel investors, they are like entrepreneurs. This is, I mean, the usual angel investor. You have an entrepreneurial background. You even have a company or more company with I don't know how many employees. I mean, we can offer this sort of expertise to them. I mean, we can do coaching with entrepreneur if he's young and so on. The focus should be on the company, I would say, not on the exits, at least at the beginning.
At some point, I found out about these 3 stages. The 3 core activities an angel should do. It's sourcing, picking, and winning, and they stuck to my brain. And sourcing, it's relatively easy because nowadays you can easily find about startups that are raising money in the market. Not so often you can find out about the good, very good startups, the very good entrepreneurs that are working in closed circles. So, please, do you want to?
I wanted to say I used to make some jokes with friends and say, look, I mean, in what I'm doing, it looks like the most easiest thing in the world, like giving money to people, but actually giving money to the right people, it's very difficult. And it's very complex.
That's not so easy. Finding the right people. So you need to have a good pool of startups you look at as a fund, as an angel also, and then you come to the investment decision. So you have to pick. It's the picking phase, and you need to have some kind of process in picking the right startups for you. And this is where many people I talk with, they are kind of stopping being business angels, But then there's the third activity, which is winning. It's not enough to be invested, to have a portfolio. Your expertise, your network, these are assets you've built making the money to angel invest, right?
Exactly.
And these assets are super useful for the entrepreneur. And this is a core thing you can bring to the table for the entrepreneurs.
Absolutely.
Andreea Pipernea, she added up that in the secondaries you can also clean the cap table in the subsequent rounds, basically. Is this an issue for you, for VCs? I don't know. The cap tables?
Not really. I mean, sometimes it depends. If you have 30 people in the cap table, it brings complexity. For example, especially if you have a company incorporated here, if the company moves to a different jurisdiction, I mean, in these Anglo-Saxon ones, it doesn't really matter, to be honest. But look, when I'm saying cleaning the cap table, sometimes maybe the first investor, they took too much equity. So, this can be a reason if there is too much equity.
Super sensitive. Super sensitive and important issue.
It affects the next round. I mean, the next rounds. And look, this is also a little bit of, I wouldn't say failure, but something which maybe not everybody is aware. I mean, when you say that, let's say, the next round is like 3 times the value of the investment round in the round in which I entered. Actually, it's not 3 times your money, because usually they are issuing ESOP. So you anyway get super diluted. So maybe if it's 3 times the value of the previous round, in reality, it will be 2 times for your money. And it will happen each and every round. It will happen each and every round.
But is this case of renegotiating basically the shares of very early angels? Is this something that comes often, or it's more an exception?
It happened to us. I would say that the market is a little bit more mature right now, the whole ecosystem. I think it happened in the past due to the lack of knowledge, honestly. There are not much investment here. People, I don't know, it looked like a fair deal for both parties. But actually, right now, I don't see it anymore. It happened, but also to us maybe happened like 2 or 3 times.
Like angels negotiating too much shares,
too much,
for the money, or too low valuation, basically.
I even seen situation where they were actually given for free, because they say, look, I can open whatever doors, and as an advisor I should get 5%. I say, look, you can get something as an advisor, but not 5%. It's way too much, for example.
Okay.
I don't see this kind of things. Again, I believe that the market goes in the right direction. Everybody understands how the game is working, what are the rules, and we see it from time to time, but not very often.
It's okay. It's an exception more than a rule.
It's more an exception, yes.
Okay. Looking now at the founders,
Yes.
how do you help them define the exit strategy? Because I can imagine at some point, I've been through this, and at some point it gets important for the founders also. Obviously, they are usually with their heads in growing the business, and this is what they where their drive is on. But at some point, their exit basically, and I don't know, maybe a VC exit that is influencing their exit gets into discussion. And I'm curious, how soon do you start this discussion, and how do you handle this discussion with the founders?
We also, at least I'm doing this as well from the beginning, because it's very important to be aligned from the beginning in these respects, because look, there are many ways to fund the business. I mean, money-wise, you can also take money from a bank. There are different ways. Okay. But in the moment when you take money from a VC is making money only from selling the company. You should be aligned on the entrepreneur to say, look, if you want to build a family business, to leave it to your kids, for example, to run it for the next 30, 40 years, it's not us. I mean, it's a valid thing to do, but not with us. So I'm having this discussion from the beginning. They should understand that, let's say, in a time frame of let's say 5 to 8 years, this company should be sold in a way. Okay, we don't sign with blood, of course. I mean, in the documents we have things, all sort of let's say provisions like the drag along, that in theory you can force somebody out, but in practice, although these provisions, the legal provisions, doesn't look fair, but in practice you cannot sell the company without the entrepreneur. So you cannot sell it against the entrepreneur, because all the time the buyer, they would want the entrepreneur to stay there. So if you sell it against the entrepreneur, you have very, very little chances to do it.
Yeah, you basically lower the value of the company.
No, but honestly, I mean, when talking about this sort of provision, I heard only about one case in the last, I don't know how many years, that a VC really exercised this drag along right, that they really wanted to sell the company and they did it. So yeah, the entrepreneurs needs to sell the company. But honestly, from my experience, I mean, they may want to sell the company sooner than you expect.
Really? Okay. So you have this discussion early, before investment, before making the investment decision. You have this discussion with them, but then you still have surprises at some point.
It happens sometimes, yeah. And it's normal, because the entrepreneurship is not an easy thing. I mean, it's very hard work, and especially working in a startup, it's really, really very demanding and so on. And people get tired. They will meet more obstacles than they foresee when they started the thing. I mean, because maybe they see let's say the success at the end of the road, but it's a very bumpy road and a very difficult one. Sometimes, again, they get tired. Sometimes they have other priorities in life, which they weren't at the beginning, but maybe you reach the point when you want to have a family or whatever, or this kind of things, and you started to. Sometimes it happens. This kind of thing, yeah.
Okay. One mention for our audience: you can see this live on multiple platforms, on LinkedIn, Facebook, and one more that I can't remember. I think Insta. If you have any questions, just write the questions as comments in those platforms, and we'll get there here and gonna answer your questions. Keeping this entrepreneur perspective, what are the challenges that you've seen them facing towards exiting the company, besides getting tired? It's obviously this entrepreneurship thing. It's not really easy. It's maybe one of the toughest thing you can do. So it's easy to get tired. But besides this, are there I don't know, worth mentioning challenges that the founders are facing and should know about?
When exiting, I mean, an M&A process, it's not very different than an investment process. You do due diligence, maybe a little bit more focused on the financials and so on, but it's not very different than an investment round. It's not very different. The transaction itself, it's way different. So that's why all the time it is to have it's good to have all the actors aligned, because everybody brings its own expertise. It doesn't happen to normal people to sell I don't know how many companies in your life. Maybe you do it like 2 times, 3 times, but usually it's the first time when you do it. So this M&A deals tends to be pretty complex. So first advice, take a very good lawyer, an M&A lawyer, which understands the terms. The complexity of an M&A process, I mean, in terms of the transaction itself, it's higher than a normal investment round, because you have many moving parts, and especially the complexity it is related to the entrepreneurs, because all of the deals, as I said before, nobody will buy the company without the entrepreneur, without the management team. So usually they have this earn-out provision. So you have many moving parts for an entrepreneur. Usually they'll get a job in the new company. Maybe they are also, for investors at the moment of selling, we are dead equity, all of us, angel investors, funds. All of us, we are not important. We just take the cash and that's it. For entrepreneur, it's a little bit more complex. He needs to secure, let's say, maybe a job inside a larger group. Some of them, they want to stay. Some of them will want to go. Then they have the earn-out story. I mean, how much money I can make. It's a moving part. They can get offers to do like part of the exit in cash, part in share exchange. There are very moving parts, and they are really. And then you put on top the fact that of the whole due diligence process done by a professional, by an M&A professional, and it's getting really, really tough, I would say, because you need to make decisions. You need to negotiate not only for you, but maybe also for the key employees. I mean, the people which were like near you in the whole process, and you also want these people to get some money. Then you also don't want to have, let's say, the investors also unhappy because they were also with you, and so on. It's pretty complex for an entrepreneur. It's a hard process. Super of course, we have more experience. We have more experience here because just happened to work with more companies, and we see how it's working. Some of the partners, also some of my colleagues, they also had like previous M&A experience. They used to do this in their previous jobs. So we're trying to help there as well. It's not only to follow, let's say, our interests, but also to help the entrepreneur to get a good deal. Because again, for the entrepreneur, there you have many moving parts. So you have the new position, you have the earnout, you have the transaction itself now, which can be cash or cash and shares or only shares or whatever.
Let's insist a bit on this earnout thing,
yes.
Because it's this as a founder, you get really happy. Oh, I'm exiting, super cool. I see a lot of lots of money and go to Bahamas or to Maldives and lay on the beach and so on. Let's talk a bit about the earnout and what are the
what is it? Yeah. So again, and at the end of the day, a company is the amount of people which made the company at the end of the day. And usually have a buyer, especially if it's a strategic buyer, they want at least the management team to stay with the company for another, in average, it's like 2-3 years. And usually it goes the following. So first of all, they need to acquire the control of the company. So they need to be at least 51%. If they reach that thing, they are not necessarily more, they don't have more incentive to buy the rest. But the rest they will buy based on an algorithm, they will say. So for example, when you start the M&A process, they will ask you for a business plan. They will say, okay, for example, you made this year, let's say 10 million in revenue. How much you will make in 3 years? And of course, you will be optimistic and will say, okay, maybe I will do 50. And they'll say, okay, based on this thing, they will pay you a price now at the value of the company which is now, and then you have a target, and they will buy your shares based on an algorithm and based on the on the achievements which you will have in the next 3 years. Because a company when it's acquired, the merging process, let's say with a new owner, it doesn't happen overnight. Usually it takes time, years sometimes. So the company will still be independent, will still work as a kind of independent company, but it will be more and more integrated in a different entity. So usually the founders, they get some cash, but not much. I mean, the most of their shares will be under this earn-out logic. So the buyer is promising, okay, I'm buying you 1/3, 1/3, 1/3 in the next 3 years, and the price will be, I don't know, it will be an algorithm.
Depend on what? The price
will depend on the
price will
achievement.
depend on achievement correlated with what KPIs usually? EBITDA, revenue.
Sometimes, I mean, the things which you can influence. Yeah, sometimes, I don't know, you can have multiple targets. Maybe you'll have also a target to keep the whole management team in place. If you lose, I don't know, the CTO or whatever, that's bad. It can reflect on the thing.
It's impacting your exit, basically.
Yeah. But it's a mix of things. I mean, usually you have different weights. You can be, I don't know, maybe 50% revenue, 30% EBITDA, and some other targets. For example, I don't know, bringing a number of new customers, these kind of things. And it's normal. I mean, because the opportunity to make more money, it's real. On the other hand, you need also to think, what if the things doesn't go as planned? For example, if the market conditions change and actually I want to reach the targets? What if the process of merging and working with the new management, it won't go that smooth, and actually everything will start to be slower, and actually I won't reach that thing? That's why it's also important to negotiate the floor. I mean, okay, I agree to have this algorithm, but at least you shouldn't pay me less than this kind of stuff.
Okay.
Yeah.
So for the
it's
founders,
pretty complex. It's not very straightforward.
Yeah. So as a founder, when you exit, basically it's a joy moment because you have a buyer, but then some really hard work begins, right? You need to get through a really tough due diligence, the most in-depth due diligence you've done, basically. And then usually you'll have an earn-out scheme, so you have to stay in the company for a few more years, and most of your money will depend on the results of the company you achieve in those years. So it's not
most of the money. Yeah, it's most of the money actually. Yeah, you will get some money also upfront, as everybody. It depends how you negotiate. That's negotiable, but all the time a buyer would want that most of the money to come as earn-out, because they think that this is the best way to motivate you to stay with the company, to do your job. And it's a real opportunity.
They need alignment, basically, with the founders.
Yeah.
Okay. Coming back to the angel investors, when we look at this angel investing journey, when you think at exit, your advice was use the secondaries, exit when you have the opportunity. Basically, don't wait for the company for the founders to exit, because it's really hard to stay as an angel so far, right? Are there any other advices for business angels?
I think we touch all the points. I mean, this is my view, and I gave some reasons, because again, you don't have any control after 2 rounds of investment. It's zero control. You'll have the lowest class of shares, and at the end of the day, being able to have a fast cycle, I think is really important. I mean, if you calculate the IRR, it's not bad. I mean, you shouldn't look only to the multiple. You should think also in terms of IRR. Other advice is, I don't know. That's the thing. I mean, try to have to help the company. Again, I mean, focus should be not on the exit. I mean, this is the last thing you should think about. I mean, of course, you should think a bit at the beginning, the way I describe it. I mean, does the company will have like real potential to be acquired? it's a I don't know what they are doing. It's a hot topic. As we have right now, AI nowadays, the same way the crypto was like 3-4 years ago, and so on. You have these technology hypes. Sometimes the hype is a hype. You can have like real things, or you can have like to be just like thin air.
Yeah. Okay, and looking at the founders, I have a question here. Bogdan asks you, can you talk a bit about some common reasons for failed exits you've noticed?
Failed exits.
We haven't discussed about failed exits.
Oh.
This also exists.
This also exists. It's not very often. I mean, things really needs to get really, really wrong. It's mainly related to misrepresentation. So basically, let's say you present to the future buyer some, basically you lie them, you know. You say, okay, this is how the company looks like. You send them an Excel file, for example, with the P&L of the company. And actually, when they do the DD, that's not true, or it's very far from what you gave them. But you can have things. I mean, this is one reason. I mean, it's common and it's stupid to do it, of course. But then you can have like a lawsuit. You know, this can happen. It's real. I mean, especially this let's say an M&A process really needs to be like a very, very private thing. You shouldn't spread the word about it, because sometimes you can get sued just for the sake of. Some person can sue you just because they know that you are in the middle of an M&A process and they are looking for a settlement. I've seen it. It's possible, even here. I mean, it's not only in the American movies. Yeah,
that's unfortunate. That's a tough thing.
Unfortunate. It's a tough thing. You get a lawsuit, and then you have, of course, you shouldn't have lawsuit, and you can get sued for different things. I mean, I don't know, maybe you touch the intellectual property or somebody else, or somebody maybe has a company with a logo which is similar to yours, or these stupid things, some crazy stuff, or some labor-related things. Maybe an ex-employee is suing you for whatever. It can happen. So that's I think is the most one of the main reasons for really failed.
And these come up in the due diligence phase, basically.
Of course. I mean, they are doing this. So they are hiring like a legal counsel, so basically a law firm, and they are obliged to do that. And of course, they cannot advise us to say, okay, go ahead and buy it. And yeah, of course, you can also have some problems with the terms if you don't accept the terms. But as I mentioned before, I mean, they are pretty common. I mean, usually you know the price from the beginning, or you have some ideas about it. I mean, how much the price will be and so on. But these kind of things, I mean, you can have this failure. I think lawsuits is one of the main reason. Then if it's not from the fault of the company, you should also have some, let's say, what we call like breakup fees, because you spend a lot of time, and usually also you have this in the term sheet. Okay, if the deal doesn't happen, you should get the company should get some money, but a big amount of money. It's usually, I mean, it's
okay.
You've seen it. I mean, everybody, you've seen it this year. How actually Twitter, at the end of the day, they managed to oblige Elon Musk to buy it.
Yeah.
He had no option.
Yeah. This is where contracts get real, basically.
Exactly.
Some signs.
Yeah.
My final question, and for the audience, if you still have any questions, please address them. My final question is in regard to timing. You mentioned timing is important at some point when exiting, right? Because if you have a depressed market as we have now, exiting it's not really at its best potential. But what do you do if the market is depressed and you have an offer, right? What do you do? How do you decide? Do I wait?
Depends on the situation of the company. It depends on the situation of the company. I mean, if you foresee that they can rise, I mean, good companies all the time they can raise money if it's a good business. Again, it depends also. for example, which vintage you have with the fund. So if the fund is close to the, let's say, to the year 9 or year 10, you are more inclined to sell and then to wait another year, for example. Of course, you can prolong it. I mean, this is not necessary that if it's year 10, you really need to sell everything. It can be prolonged for another couple of years. But yeah,
Okay.
this is a part of the timing. Then it's also about the situation of the company. Do you have runway? How were the discussions with potential investors? How they are going? And if you don't have runway, what else you can do? Yeah.
Can you wait?
Yeah. Can you wait? How long do you need? If you have a runway of 2 years, of course you can wait. For example,
Okay.
or are there any chances if I don't have runway to go cash positive?
To raise money.
To raise money or to go cash positive, you can, I don't know, fire some people, reduce the cost, get new customers, and get okay. Of course, you will grow slower than with the new money, but you can still be valid. This is also a way of solving this, let's say, dilemma.
And also in this timing perspective, we have these macro trends, as you already mentioned, this AI thing. Now it's the whole huge change brought by OpenAI with generative AI. How do you assess these things? Because you have a new technology, amazing technology. You have a ton of startups, and not only startups that were immediately impacted by this technology, and you have to think long term, right? If I invest now, what will happen with this macro trend in 5-6 years until I exit? How do you assess this thing?
I think there are so many things written about this topic. I don't know with what to start. Personal opinion and so on. Yeah, no, I don't know. It's very difficult to comprehend. I mean, really this is a separate discussion. Honestly, I mean, it's like it's too broad.
Yeah, let's have a chat on macro trends and how do you use macro trends in making decisions. We have one more question from Bogdan Bukalayek, I think. What is the average period to keep a company? Let's separate it for an angel, for a fund.
I mean, statistically, it goes like this. The average holding period for a fund, it's around, let's say, 5-6 years, but depends, I mean, of the fund. I'm talking about early stage funds like seed/Series A, I would say. It's something like that. But of course, you have larger funds. You have the pre-IPO funds. For them, the holding period, it's up to 1 year. I mean, they don't do big multiples, but they do it very, very fast. For angel, I would say that 3 years in average, it's a good holding period, but maybe you guys should have this answer, not me. I mean, I just know I don't do that, so I know just the statistics. So maybe
the question is for you.
It's for me. I think because in 3 years you can do, let's say, one investment round, and the second one you can exit if you have the chance.
So basically, invest in pre-seed. As an angel, you'll have the follow-on question in seed when the startup is raising the seed round, and then exit in I don't know, late seed or Series A, something like that.
If the round is big enough, of course. If it's a 2 million round, you cannot sell. I mean, if there are enough money, usually it goes again like for good companies, because sometimes you have oversubscribed rounds. So you have like a fund which is coming late into the process, and I say, look, I want to invest, but I want a minimum of whatever ticket into the round, and you cannot give it because you give away too much equity. And then this is an opportunity to do a secondary, for example. I say, okay, you can participate in the round with, let's say, 80% of the ticket which you want to put, and maybe 10-20% you can do a secondary to reach your target. So this is how it's working.
Okay, this was a super interesting discussion, and basically it's the whole objective, right? Exit is the whole objective of the whole game. It's about winning in this venture space. Cosmin, thanks a lot for this discussion, and if you have anything else to add, please. Any idea you want to leave our audience?
Maybe we talk in Timișoara about some other.
Yeah, we'll meet in Timișoara in 27, 28 of October at the Invest in Unicorns event. Basically, a 2 days event about angel investing, about this venture world. So yeah, looking forward to discussing more about this. Thank you, Cosmin.
Thank you for inviting again.
Thank you, everybody, for. Sorry.
I hope was interesting for everybody.
I think it was super interesting, and I hope also for our audience it was the same. Thanks a lot. All the best until next time. Take care and have good exits.
Thank you. Same to you.
Bye.